Hey guys, what's up? I had somebody leave a comment on a video recently that got me thinking a lot, and I disagreed with it, but I don't think he was leaving it in bad faith or anything. I think you guys do a good job of keeping the comment section really positive on Final Trade, and so I think it was a good faith comment that you left, but I think it was wrong, and let's talk about it. If you spend a lot of time on other forums for investing, then don't do that because they're mostly cesspools and you'll pick up a lot of bad ideas. So, that's just kind of the reality of it. Having myself spent 20 years on investment forums and just kind of realizing that there's not a lot of actionable information you'll ever get out of those kind of discussions with just random idiots on the internet. So, what this particular person said was that an asset has to generate cash flows to be an investment. Otherwise, that asset is just a speculative instrument. And you'll see these kind of like repeated tropes in financial forums all over the place. You'll see variations on them. You'll see a couple of different ones. There's three or four most common ones that I see a lot. And they're all wrong, but the thing about them is if you just stop and think for yourself a little bit, think about exactly what is being claimed and try to come up with examples that support the claim, and then try to come up with counter examples and see what you can figure out for yourself. But the most important thing about these tropes that go around is that you think for yourself. And so this particular one, that an asset has to generate cash flows in order to be an investment. And now the first thing is, like, who cares if it's an investment or it's a speculative instrument? Who cares? What we're chiefly concerned with is compound annual growth rate. We don't care if some guy on the internet says, you're just speculating on something, or, ooh, he's investing. Yeah, who cares? We're here to make money. And so compound annual growth rate is what you care about, not what somebody categorizes it as. But, think to yourself about different types of investment instruments and whether under this claim that we're making that to be an investment it has to have cash flows, do these instruments qualify as investments or speculations? And does that make sense? So let's think about a couple of things. So what if we had zero coupon government debt? Okay, and what that means is that normally when a bond is issued, let's say you pay $100 for the bond, and then the agreement is at the maturity date, you will get $100 back for that bond, and the bond will be retired. And in the meantime, you will get some incremental payment. Let's say every 3 months you get $5, something, I don't know. But a zero coupon bond works differently. The zero coupon bond says that I will pay you, or really the government will pay you back $100 at maturity. They will pay you nothing in the meantime, but right now you can buy the bond for a mere $90 or $95 or $80, depending on the term, depending on the credit worthiness. If it's Swiss sovereign debt, you can buy it for $105 and they'll pay you back 120 years. And yes, those kind of bonds actually exist, and yes, there are good reasons that people buy them. But if it's a zero coupon bond, it has no cash flows. Simply, the issuing authority, whether a government, a business, a municipality, whatever, they simply buy the bond back from you at maturity. So there are no incremental cash flows. So would it make sense to say that a Swiss government bond that was zero coupon is not an investment? Would we scoff at it and say, that's just speculating? You're just speculating that Switzerland is going to be solvent in the future? Of course it is. I mean, that's not speculating at all. That's an investment. And so part of what this discussion gets to is that there's not really a good definitional differentiation between investment and speculation. That's one thing. But the other thing is about these tropes that get thrown around and ways that we can come up with example instruments, financial instruments, that prove or disprove them, and in all cases really disprove them. But another interesting example would be, okay, so if we're going to keep testing this idea that something cannot be an investment unless it pays you cash flows, Let's say you were going to do a pair trade in the stock market. And what a pair trade is you'll buy two different companies' stocks that are related somehow. Sometimes they are tied together, sometimes they are inverts. It depends on what you're trying to do with the trade. But one common one you'll see people do in the US is they will buy stock in Lowe's and stock in Home Depot. And Lowe's and Home Depot, if you don't live in the US, they're two home improvement stores. And they're basically direct competitors. They are the two largest home improvement stores in the US. And so let's just pretend, and I don't know what the actual case is, but let's just pretend that Lowe's pays a dividend and Home Depot does not. Would we say that buying shares of Lowe's is an investment, but buying shares of Home Depot is mere speculation? No, that wouldn't make any sense. They're both investments. You're buying the stock. Another example that we can use on this kind of trope is undeveloped real estate. So let's say you go out and you spend $500,000 and you buy a piece of undeveloped real estate. Okay, it has no utilities on it, no paved roads. It's just raw land. Maybe it's got trees or maybe not. And every year you have to pay property taxes on it. Okay, but ideally the value of the land increases more every year than the amount of the property taxes you paid on it, so that overall the value of that asset is going up over time. The total amount you've paid for it is less than it's worth in the future. And would you say that because it has in fact negative cash flows, because you have to pay money out of your pocket for property taxes every year, that's not just not investing, it's even worse than speculating. It's some kind of like awful negative investment. No, you wouldn't say that. And we wouldn't say that people who buy real estate are not investors. In fact, we all just kind of colloquially call them real estate investors. So you can see how you can take different financial instruments and you can use their attributes to test these kind of tropes that you will read on financial forums. And like I said, we don't really care. As investors, we don't care whether returns on our investment come from asset appreciation or from cash flows. Because ideally, what we would be doing with those cash flows anyway is reinvesting them either in the same asset or in a different, better priced asset at the time that we get the cash flows. All we care about is the compound annual growth rate. That's the only thing in the long run. And it can come either just from asset appreciation, or it can come from asset appreciation and dividends, asset appreciation and coupons on bonds, asset appreciation, and maybe you buy 100 acres of land and every year you chop off an acre and you sell it. You know, it can come from any type of cash flow that you generate out of an asset. It doesn't matter. What we're interested in is at any given point in time, what's the total value of all those assets? And how does that compare with what we initially invested to get our compound annual growth rate? And so, there's some more of these kind of word salad nonsense kind of tropes that you'll read. Another one is it's only an investment if it has revenues. And this one I think comes less from anybody actually trying to honestly make this argument. I think it comes from people getting confused over the not so subtle difference between an investment paying you cash flows and the underlying asset of an investment itself having revenues. And so I feel like this is just kind of a derivative one that people kind of accidentally invented. But again, not every asset has revenues. Obviously, some people like investing in precious metals, and those don't have revenues. Bitcoin kind of does have revenues. I mean, every time there's been a hard fork of Bitcoin, you get a bunch of like the other new coin, and so like you could sell that and have a lot of revenue. So it kind of at an edge case has revenues, but not normally. But people would not say that Bitcoin is not an investment. And so, and again, with real estate, if you had undeveloped land, so it was not, it did not have an apartment building on it paying you rents, but it's just undeveloped land and you are in fact paying property tax on it, those are negative cash flows. And so again, people would not say those are not an investment. Another one, people do the same kind of like non-thinking word salad nonsense with intrinsic value. And I've made a video on that one in the past. I should probably make another one. But, they'll make claims about what is or isn't intrinsic value, what has or doesn't have intrinsic value, what qualifies as intrinsic value. And, a good kind of bit of guidance is when you see that much disagreement based around the definition of something, you should probably start questioning whether or not the thing we're trying to define even exists. And the reality is, intrinsic value doesn't exist. It's not a real thing. There is no minimum price that some assets have based on some emotional argument of what it can do for you. I mean, some people will make these weird arguments that, like, food commodities have intrinsic value. Like maybe a wheel of cheese has an intrinsic value because you can eat it to stay alive. So it'll always have value. And, I would argue a pile of dead cockroaches could keep you alive if you had to eat them. But, there's no market anywhere trading in dead cockroaches to try to establish what the price of them is. There are no buyers with bid prices hanging out there for tons of dead cockroaches. And so just because something can be eaten doesn't mean it has an intrinsic value. And the other part of that is that when it comes to commodities like grain, beans, corn, stuff like that, as we saw in 2020, commodity markets can go negative. You can have to pay money to get rid of a commodity that you have because there is no storage space for it. That's what happened in March or April of 2020 with oil. There was no more storage space and people had contracts to deliver oil. And so they had to pay to get rid of their oil. Their oil had a negative value. And so, there is no underpinning of a minimum intrinsic value of something. And so, you'll see other things like it has no intrinsic value unless it has revenues. And it has no intrinsic value unless it produces cash flows. And so people will just kind of try to combine these things. But again, you have to think for yourself about this stuff. You have to say, can I think of examples that prove this or examples that disprove this? And what if I can? What if I take this piece of advice from maybe someone you respect and you start coming up with examples that disprove it? Then you need to spend a lot more time thinking about that thing, coming to your own conclusion about whether it's right or not. Another one that I talk about, another one of these tropes, and in fact I made a video about this not so long ago, is don't catch the falling knife. And that one's totally wrong. You make the most money in investing long term when you reach out and you catch that falling knife. And it comes down more to psychology and the people who just kind of mindlessly repeat not to try and catch a falling knife in a market. They're falling into a fallacy that they can predict the future, and they never really logically step through the steps of how do you go from not catching the falling knife to actually profiting in the future? And they don't think about how they would get there, because if they did, they would realize there's no reliable way to do it. The reliable way to profit in the future is to catch that falling knife. That's the best time. This time is different is another great one. And that one is so subtle because most of the time, this time is not different. But rarely it is. And people will just kind of parrot the line mockingly and say, oh yeah, this is different, putting a computer in every device. Well, that really was different, We've pretty much taken a computer and stuffed it into nearly every device we use now. And that made many of those devices fundamentally different and changed markets. So sometimes markets really are different. Things happen that are novelly new. And a lot of the times, no, but the real wisdom is to be able to examine it for yourself, think about it critically, and figure out whether or not this time is different or not. So, those are some examples. And like I said, I don't think the guy who brought this up in the comments, I don't think he had bad faith or anything. I think, he's probably just read these kind of things a lot of times and he's never challenged them himself. And he's probably never had anyone really say, hey, why don't you go challenge these? Why don't you try to think about other assets, think about different instruments and think critically about this stuff and see if you still think this is true. Because, the skills of being able to critically evaluate these kind of things are useful everywhere in your life. And so, do that, think about it, tell me what you think. I always feel like these videos ramble on as I'm filming them, but then when I review them later and I see your guys' response, it's usually pretty good. So let me know what you think about this one. Otherwise, like, comment, share, and subscribe. Join me on Final Trade. Join the Patreon.